My name is Andrew Stotts, and I want to welcome you to the Valuation Masterclass Bootcamp live presentation. In this presentation, you're going to hear from one of our students who's been studying for the past 6 weeks. In other words, they're at the halfway point of their 12-week journey. It's truly a journey of transformation because for many of the students, they never wrote professional research. And here you're going to see in just a moment our student who has basically been given a company 6 weeks ago and has now got a complete report on it. And I'd say, has thought about it quite considerably. His name is Warwick Gunn, and he's going to present for those people that are interested in joining the next Valuation Masterclass Bootcamp starts in 68 days from now. And you can get, for the next 7 days, you can scan the QR code and you can get a sizable discount that can get you into the next boot camp so that you are the one presenting the next time, which will be very exciting. So let me bring him in. Warwick, how are you doing?
Hi, a bit nervous, but fine.
Tell the audience just a little bit about your background.
Hi, I'm Varakan Anuttarakul and I'm currently studying in master degree of financial engineering at NIDA, Thailand.
Exciting. And boy, it's a different world, right? The theory of master's degree versus what you're doing with your report on FASTENAL, a whole different world, right?
Yes.
Yeah, and you've done a lot of work on it, so I'm going to let you get started. Let me just bring up the report there. I can see it on the screen. That's exciting. So I think we're ready to go. And I'm going to leave in just a second. And when I do, then you can start. So I will leave now. You can start now.
Imagine a great company with an amazing fundamental. Everything looked good except one thing, which is a price. Hi, my name is Tang, and today I initiate coverage on fast with a sale recommendation based on a target price of 33 US dollar, implying a downside of 29%. I derived my target price from a DCF-based valuation using a WACC of 8.5% and a terminal goal rate of 3%. But who is FAST? FASTENAL is a highly profitable North American distributor of fastener and MRO supplies. The company's competitive edge relies on a dense supply chain concentrated in the US. Its growth strategies prioritize deep customer integration over traditional physical branch. But why I initiate a sale? First, growth is slowing down to single digit below what the price assumed. FASTENAL grow by signing new customers and selling deeper into the one it has. That engine still runs and daily sales rose 12% in the first quarter. But signing grew only 8% last quarter and device base only 6%. Once the base is this large, single digit signing cannot keep revenue growing in the low double digit. I forecast growth slowing down from 12% in 2026 to 8% by 2030, far below the steady double-digit pace that 42-time earnings would demand. Next is operating leverage is thin and nearly tapped, capping margin upside. FastNow win more growth inside big national account. They achieve to serve once the hardware is installed, and the cost discipline is real with SG&A go down. But gross margin is sliding too by 0.5% on the heavier context mix. So even with sale up, operating margin just barely lost. I expect that it will be near 20% well short of the calm that price assumed. The last but not least thing is the market is paying for perfection that won't show up. FastNow trade at 37 times forward earning, a 50% premium to the US industrial sector, a lovely double the world. That price only makes sense if three things are all hold. First, double-digit revenue growth continue. Second, the operating margin keeps climbing from 20%. And third, the 30 plus percent ROIC stay far above the industry average. Crediting a great business, I still see it as paying today for growth and margins the next 3 years are unlikely to deliver. So let us look at the industry that company in. It's a fragmented and cyclical industrial market, with projected to grow 5% CAGR. North America lead with over 40% of global market share, anchored by W. Granger and FASTENAL. IoT and automation are redefining industrial growth and surging trade tariff compressing margins. On the first quarter, FASTENAL grew double digits, but its margin is barely moved. And on the latest news, FASTENAL reaffirmed its 2026 goal of 28,000 to 30,000 weight FMI signing and is adding capacity, including a new $90 million hub in Georgia opening next year. The consensus hold a cautious view on FASTENAL. The mean target price implied only 0.7% upside from the current price, suggesting analysts see the stock as fairly valued. On the revenue structure, the company is a diversified mix, keep growing as fastener come back. And manufacturing customers generate about 75% of sales. Geographically, the US dominate with 83% of revenue, while Canada and Mexico at 14%. With FVMR framework, Fast looks strong on fundamental and risks with above than average momentum but expensive on valuation. The company is among the strongest with asset turnover rising to 168%, but is trading on a very high PE of 40 times and 13 times price to book. And the momentum of company is average as revenue and earning per share growth recover. And on the risk side is low, as fast is net cash with negative net debt to equity. With world-class benchmarking framework, it had ranked number one against industrial companies worldwide every year with a top-tier profitability built on world-class asset efficiency and expense control. On the growth is the weaker leg, though it is improving. I forecast that the company revenue will reach 13 billion US dollar by 2030 and the net profit is improved to reach 2 billion US dollar by 2030. On the cash, the company cash is projected to be on the level of around 300 million US dollar as the company not have significant capital in expenditure. And on the account receivable, the company is projected to increase to reach 2.1 billion US dollar by 2030 as the mixed national account pays lower, which will increase the demand on the overdraft and short-term loan to reach the 200 million US dollar by 2030. And the net income of company is improved to $2 billion, which will naturally improve the operating cash flow to 1.8 billion US dollar by 2030. And I forecast that the gross profit of company will slip down by 1% on 2028 to reach the level of 44%. But the EBIT margin is expected to stay the same on the level of 20%. I forecast that by 2028, the company pace on the revenue growth will fall from its low double digit to reach 9.5%, but its net profit margin still stay on the level of around 15%. The company EBIT is improving to I forecast that it will reach 2.6 billion US dollar and its NOPAT is improved to 2 billion US dollar. So I forecast that the free cash flow to firm of company to be 1.8 billion US dollar by 2030. When we look at the relative valuation, FASTENAL is traded on the 30-time price per book, roughly double the 6-time US industrial average. But the company is generally premium as it has a superior return on equity of about 35% superior than its peer globally. But still, when adjusted for that quality, the company still look expensive when compared to its peer. And when we look with to price to earning, the company trade at 37 times earning, a 50% premium to the US industrial sector. And even we adjust it with growth, it still look expensive when compared to its peer. So I assume a risk-free rate of 3% and the equity risk premium of 8.5% with a beta of 0.8 times, which gives a cost of equity of 9.4% to derive a WACC of 8.5% with terminal growth rate of 3%. So I derived the 33 US dollar per share on the free cash flow to firm methodology, implying a 29% downside to the current price. With the sensitivity analysis, I found that even the sales growth or the gross profit margin increase, the company can reach the level of 40 US dollar per share, which is it currently trade in, showing that the company is overvalued. The company main risk is an industrial slowdown to volume. A recession or prolonged soft demand will slow signing, shrink the order flow through the install base. Mix shift to national account squeeze margin. Device network mode erode as rival catch up. And customer and supply chain concentration in a cyclical market as FASTENAL is concentrated in North American industrial and is heavily reliant on overseas suppliers, especially in Asia. And that's all for me and FASTENAL, a great business with an indefensible price. Thank you.
Excellent. Yeah, so the first question comes from Christiana. And, I've looked through your numbers now. And so I'm just curious, to what extent, is it the sell recommendation driven by a deterioration in the business? Because you do have some, conservative or maybe even negative perspectives of what the business is going to look like. Or is this purely valuation, as you discuss in point 3 of your story points?
It's is mainly driven by the valuation concern, as the company is still perform well above its industrial peers. However, the current market is pay the premium too expensive when compared to its intrinsic value. Even with the scenario analysis that show an even bigger bull case, which is unlikely to happen, it still can't reach the current price that it trades.
And another question comes in about significant story behind SG&A. What's going on with costs and SG&A?
On the SG&A story, the company maintain its cost due to its business model that is built on the embed on its customer, and they closing more and more its physical bench, which bring SG&A down, but still that's not enough to improve the operating margin.
So how does it feel to complete this project? 6 weeks of work, and here you are, you just finished it. How you feel?
Oh, it's an amazing. It improved me a lot.
Yeah, think about it, where you were when you started. What would you say is the main improvement that you feel, or the difference, the transformation that you've gotten from what you've done in these 6 weeks?
The main improvement is the change of perspective. For me, I like history. It's told reflection of the past. So for me, if I'm an analyst, I will focus more on like what the past has happened and how it's affect the current. But I like the perspective on what future will happen. This bootcamp helped me a lot on the forward perspective.
Yeah, because we already know what's in the price. Now it's really a matter of what this company's going to do. It's one of the questions about FASTENAL too is, I wish that they could see the opportunity that they have globally, but I just don't think that they just don't see it that well. Maybe they just see it as a risk, or maybe they don't see the opportunity. But thinking about the future, that if they had a change there, that could be a change, that would have a meaningful impact. But yeah, good. Well, I'm going to let you go there, and I'll see you in the Slack group. But you've done a good job. You should be proud of that. And then, yep, we will see you in just a bit. All right. Well, there you go. That was an excellent presentation by one of our students studying his master's in finance right now, but getting practical skills in valuing companies and writing research. If you want to build a competitive advantage in company valuation, join us in the next Valuation Masterclass Bootcamp. And the next one starts in 68 days. You can get, for the next 7 days, you can get a $1,900 discount but only in the next 7 days. Just scan the QR code or go to valuationmasterclass.com and then use VMCBC Live to get it. My name is Andrew Stotts, and I hope that you build a competitive advantage in company valuation.